increase in expense and increase in dividend, it is written on the left hand side or debit side. Guys, are we clear? Nana?
Yes.
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 So there is a snapshot here.
Yes.
So assets is equal to liabilities plus owner's equity. So remember, if asset increase, we write it down on debit side. If asset decrease, we write it down on credit side. So remember, debit means positive, answer is no. Credit means negative, answer is no. These are the sides, right hand side and left hand side. So on the other side of the right hand side of the equation, increase, if liability increase or common stock increase or retained earning increase, we write it down on credit side. Similarly, revenue increase, we write it down on credit side. Dividend and expense increase, we write it down on debit side. Logic I already told you, because increase in dividend causes decrease in stockholder equity. Increase in expenses causes decrease in stockholder equity. That's why if stockholder equity decreases, we write it down on debit side. So don't get just worried about this plus sign here. Plus means increase. So don't get confused with the mathematical stuff. Okay, plus mean increase, negative mean decrease. Look at the logic here. Dividend increase will be recorded on left hand side of the stockholder equity. So this is just the enhanced version here, simple. Liability increase credit, asset increase debit. You guys can take a picture and you can just memorize this, or go through with this stuff one more time, even because we will be having our next class after 15 days. Just confused or don't forget, because many students, when they come after 15 days, many of you already forgot about this. So during this holiday, I want you to please at least 1 or 2 times repeat this stuff and everything is okay. So say asset increase debit, dividend increase debit, expense increase debit. So dividend and expense are assets, because their treatment is like this. Answer is wrong. Answer is wrong. Though it's plus minus written side like this, but the logic is that this dividend and asset, they belong to stockholder equity. Guys, clear?
Yes.
Clear.
So you need to be very participative today, because this is very important stuff. I need to make sure that everybody understands this stuff. If you want me to repeat, I will repeat it. If any one of you don't understand this, please ask me to repeat. Should I move forward or should I go through one more time? Everyone.
You can go forward.
Spike.
Yes, sir.
Momo, TD, good? How about you?
Yes, all good.
Yeah, all good.
Hen, Joe Paulo,
Yes, all good.
Yes, sir. All good.
Maria, Tara, Marco, Priscilla,
Yes.
good. Oliver,
Yes.
good. Good. Well done. Similarly, the stockholder equity accounts common stock, retained earning, dividend, expenses, revenue. We already talked about that. Dividend increase will be or expenses increase. We will write it down on left hand side or debit side. Let's move forward. Now we are actually diving deep into the world of accounting principles, double entry accounting principles. Here, record, journalize, and post transaction into books. Books, the accounts. like books. So we denote the books with, this is cash book, so we write it down with cash T accounts. Right hand side is called credit, left hand side is called debit. Okay. So what is the journal? We call this in double entry accounting system, we call this journal entry, which means which record all the daily transactions. Okay, you purchase this one, you purchase that one, everything is recorded under journal. So this is not the accounting, this is not the account. This is a book which just record transaction chronologically, date wise. It's not like that, you know, date 1, 2, 3. It doesn't mean that, you know, you can record it 3rd February transaction before 1st February. No, it's chronologically record transaction daily basis, right? Okay, what we have done up till now, okay, everything you write it down here, and then from this journal book, you transfer those entry into books of accounts, right? So this entries, so this will be written on journal, and from journal you make entries in books of accounts. So these are chart of account, these are books of accounts, and the name is called charts of accounts. We will talk about charts of account in our coming, I think, slides, or in our next lecture we'll talk about that. So how we make the journal entry? There are 3-step process. Number 1, you need to specify from the transaction that it affect which accounts, which at least 2 accounts, whether the 2 accounts belong to asset or liabilities or whatever the combination is, asset or liabilities, asset or owner's equity, what. And at the end, equation must be balanced, right? Then you need to determine that whether the account is debited or credited, increase or decrease, which side will you need to write down, and then you make a journal entry. There is a specific way to record the transaction. The accountants record the transaction so that only that person understands the transaction which actually have the knowledge of accounts. Otherwise, no layman can understand what's going on here. So it can keep your business secrets as well, which you don't want to show to the general public. Here we go. Let's make the journal entry. So how we make a journal? Journal is, this is, we draw a line here like this. Here is the date. Here is particulars, accounts particulars, A by C or accounts particulars. This is debit side, this is credit side. Of course, in some dollars, or this is currency, like this 400. What is 400? Units or whatever, measurement what? Dollars, okay? So you write it down like this. So if it is debited, you write it down here. Here, if it's credited, you write it down here. But there is a specific way. We talk about that, how we write it down. So on April 1st, you need to generalize the entry. Business received 50,000 cash and issue stock. So which 2 accounts are hit? You write it down, cash and common stock. Write it down, increase or decrease. Which side? They are increase. Cash is asset account. Asset account means debit. Common stock increase. Common stock increase means credit. Now, how we generalize the entry? There is a specific way to write. First, we write the debit. So, which one is debited? Cash. So, we write it down cash here. Cash is debited. So, you write down on the debit side, this is dollar 50,000. Either you write dollar for every every figure here, or either just write down once dollar here. So you automatically know that this figure here all in dollars, right? So here cash 50,000. Which one is credited? So then you write it down the common stock, but there's a space here. You at least gave 6 spaces or 1 tab. You write it down common stock. It is credited 50,000. You see all the debit is equal to all the credit. 50,000 is equal to 50,000. Right? So accounting transaction is journal entry is balanced. Right? Understand? Guys, I need your participation. Everyone
Yes.
Good.
Yes.
Yes, sir.
Cash
Oh, good. Thank you.
transaction. So if I tell you business receive 50,000 cash and issue stock, and then you thinking about okay, which account is increased, which account is decreased, you try to process in your mind. They don't tell you this one. They just pronounce this. How? Cash to common stock. How we pronounce it? Cash to common stock. Cash means, so the first one here is debit. The next one here is after 2, the account is credit. Cash to common stock 50,000. What does it mean? It means cash is debited 50,000. 2 means now credit. I'm announcing the credit side. Common stock 50,000. Simple. How we pronounce it? Oliver, how we pronounce it?
Issued common stock.
Cash to common stock. 5. Cash to common stock, right? Subhan, cash to common stock. Now, if you already understand the accounting, now you know that, okay, cash to common stock. Okay, it means cash to means it is credit. So you write down here, there's a space here, cash to common stock, 50,000, 50,000. So cash must be debited and common stock must be credited. So this is how we pronounce, how we talk on phone. Okay, the accounting department, business receive 50,000 cash and issue common stock. So the accountants, they talk about this. Okay, sir, cash to common stock 50,000, and that's it. Right? It means they are recording journal entry, cash to common stock 50,000, balance 50,000. So there are, so these cash, accounts payable, common stocks, these are all called individual accounts, right? And this account, individual accounts, this cash they belong to asset. We already talked about that. Accounts payable belong to liabilities, common stock belong to honor equity. And at the end, their balances, asset balance must be equal to liabilities plus honor equity. So that balance sheet is equal. Balance sheet equation is complete, right? Now, posting. Recall our the learning objective here. What was that? Journalize and post. Recording means journalize and post. We make the journal entry. We call this cash, this common stock. This is journal entry. And now we are posting it. Posting means